In this presentation, we will work a problem related to the two methods for tracking and recording inventory, supplies inventory within fund accounting, that being the consumption method and the purchases method. We're going to have the information on the left side for year 1 and year 2. We're going to enter that information into the blue areas on the right side, including the general journal for the consumption method, which we will then post to our trial balance, where we have a beginning trial balance, ending trial balance, and then the adjustments that we will post. This will give us an idea of the accounts, give us something that is going to be in balance, so we get a better idea, better grounded conception of what is actually happening when we record these transactions. We'll do the same thing with regards to the purchases method. We'll go through the same process. We'll do this for year 1, and then we'll do this for year 2, so we can see how this flows through from year to year. And then we'll do the same thing with regards to the general activities, the government-wide activities, this being more on an accrual basis, so this will be familiar. We'll basically be able to format this and compare it to what we would typically see in the government-wide type of activities. Okay, so then we're going to go through this. This is going to be year 1, supplies ordered at estimated cost. So we're going to say that the supplies have been ordered. They have not yet been, an expenditure yet. This is kind of like the purchase order that we would have. So this is the estimate. This is kind of like the funny transaction that we would have that isn't actually an expense. We're not going to record the actual supplies that have been received. We're going to put this into the encumbrances. That's that holding account that we're going to have. So the holding account, so we're going to say, all right, the debit is going to go to encumbrances, and the credit is going to go to the encumbrances outstanding for the estimated amount that we have of that 847.5 debit and credit. Let's record that, see what happens. Encumbrances down here. So I'm in the middle column, J15 equals the debit. And then we're going to go to the encumbrances outstanding. Here it is. We are in J10 equals the credit. So there's our first transaction under the consumption method. We're looking at the consumption method here. And then the second item has that the supplies received. We got the supplies at the actual cost here. So now we have received the supplies. This is where we would typically record something under the accrual method. So now we got to reverse what we did last time. We're going to say that we got all the supplies related to this estimate. The actual amount is this amount. So first we need to reverse the encumbrance because this is that holding account. So we're going to reverse it entirely. And then we're going to record the supplies transaction. So I'm going to say, all right, encumbrances, outstanding debit, encumbrances, credit. We're going to reverse this exactly. And it's going to go back to 0. So the clearing account is going to go back to 0. This is what I mean by a clearing account. Goes up, goes down, not in accordance with basically a temporary account closing it out to equity, but or the related equity account, but going up and down in accordance with some other determining factors. So, right. So now we're going to increase it. Now we're going to decrease it entirely. So here's the encumbrances outstanding. I'm going to be in B or J10. Something's in it. Double click on it. Go to the end of it. Plus. Point to the 847.5, brings it down entirely. Then we have the encumbrances. That's going to be down below. So we're going to be here in J15. Something's in it. Double click on it. Go to the end of it. Plus, and then point to the credit and enter. And so we have now reversed that. Then we're going to record the supplies, and we're going to record this as an asset. So now we got the supplies. We're going to record it on the books as an asset. So we're going to say, all right, there's the supplies, asset. And we're going to say that we paid cash. So we're going to say cash, credit. Okay, so and this is going to be for the actual amount. So the actual amount, not the estimated amount. Now we'll record this, supplies, asset up here in green. We haven't consumed it yet. We are in J6 equals the supplies, increase in the supplies. And then where you have the cash, that's going to be in J3 equals, and we're going to say the cash is going to go down. So there we have that. We're back in balance. Next item that we're going to have is going to be, let's say number 4, that we have the supplies remaining at year end, 77,100. So what we're going to say is what's on the books right now in supplies is 851,500. We counted it at the end and we say that there's 77,100 left over. 77,100. So what we would expect to do, and this would be normal kind of periodic type accounting, is at the end of the year, we're going to write it down to the actual physical count. So we physically accounted it, we're going to write it down to the physical count. So what we're going to do is say supplies needs to go down. It has a debit balance. We're going to credit supplies. That's what's in supplies right now. It needs to go down to 77,100. Credit supplies, and the debit is going to go to the expenditure. So this is how much we're saying or assuming that we consumed, and therefore the related kind of expense account, the expenditure account. So this is going to be equal to the 851.5 minus the physical count, 77.4, and the credit then is going to be the same. So let's post this out. This should leave us with the 77,100. So we're going to post the expenditure. That's going to be down here. We are in cell J14 equals the 77,400. And then we're going to go to the supplies. Here's the supplies. We are in J6. Something's in it. Double click on it. Go to the end of it, plus, and then point to that 77,400 and enter. That takes our balance down to the 77,100. So now we have 77,100 in the inventory. Here's where the funny kind of thing happens here. We're going to say that the equity section, we need to reallocate the equity section. So you'll note that we have the fund balance unassigned and the fund balance non-spendable. What we want to say is I need to take the amount of equity, because remember what equity is. It's the assets minus liabilities, or in other words, asset minus liabilities equals the 168,600. And then equity, and then decreased equity, because the whole income statement is going to roll in to the equity. That's 168,600. So in other words, this equity section, once we close out the income statement accounts to it, represents the net value, the net balance of the accounts. And whenever I say equity, that would be for profit. I'm comparing, that's what I would call it for profit. It's probably a term that many people are most familiar with, but the concept, is going to be the same. This is going to be the net assets of the company, assets minus liabilities, and we want to be able to assign that and say this is the unassigned portion and this is the non-spendable portion. So what we're going to do then is say that we have, this is going to be equal to the fund balance unassigned, and we have the fund balance non-spendable, because what we're saying is the equity related to that 77,100 is non-spendable because we have that asset on the books and it's related to that asset. So we're going to say that this is going to be 77,100, credit 77,100. Remember that these are equity accounts, so this is going to be increasing the non-spendable, decreasing the unassigned. So let's post it out. Here it is, unassigned in J8. This equals the 77,100, bringing it down. And then we have the fund balance non-spendable in J9 equals, and we have the credit, and that's going to increase this amount. So there we have that. Now we're going to do the closing entry. This is the only activity we have. So we're just going to close out our income statement accounts, which only has the expenditure to the equity, and it typically is going to close out to the unassigned. So I'm going to say, all right, we're going to close out all of the income statement accounts. This is a debit balance, so we need to credit it. I'm going to put it on the bottom then, expenditures, and on the top, we're going to put the fund balance unassigned. And that's going to be for 774,400 to make it go down to 0. So here's the fund balance unassigned. Here's the fund balance unassigned. We are in J8. We're going to double click on it, go to the end of it, plus, and then point to that 774,400 and enter. And then on the expenditures, we're going to be in the expenditures in J14. Double click on it, go to the end of it, plus, and point to the expenditure, bringing it down to 0. So now we have a post-closing trial balance, and we're left with the assets minus the liabilities at 168,600, equaling the equity, 168,600, and then the equity being broken out between the fund balance that's non-spendable, because it's kind of matching up against that inventory asset, and then so it can't be spendable because it's representing the asset portion. It's kind of how you might want to think about it. And then we have the fund balance that is unassigned, that is going to be here. Okay, so now let's move down to year 2. What happens in year 2? We're going to take these ending balances. This is our post-closing trial balance. That's going to be our beginning balances for year 2. So this is where we stand. We've got the inventory on the books now, and we've got this fund balance non-spendable on the books. So let's see what happens in a round 2, year 2. So we're going to just continue on, and we're going to say same kind of starting point where we have the estimate happening. So we estimate that we have 855,400 purchase order. We're going to debit the encumbrance again, just like we did before. Debit the encumbrance for the estimate. We're going to credit the encumbrance outstanding, same starting point. And for the amount of the estimated amount of 855,400. So now we're going to post this. Here's the encumbrance. Here's the encumbrance down here. This equals the encumbrance. Here's the encumbrance outstanding. That's going to be in J29 equals the encumbrance outstanding. So there we have that. And then we got the supplies were received. So we're going to do the same process here. We're going to take those supplies that were received. We're going to put them into the supplies inventory. But before we do that, we're going to have to reverse the encumbrance. So we're going to reverse the encumbrance exactly, just like we did in year 1. So I'm going to reverse the encumbrance because now we got to record the actual supplies. We're recording supplies and not an expenditure because obviously we're putting it on the books as an asset here. And so we're going to reverse the encumbrance exactly in the same fashion as in year 1. No difference there. So here's the encumbrance outstanding. Something's in J29. Double click on it. Go to the end of it. Plus. Going to point to that item and enter. That brings it back down to 0. And then the encumbrances, something's in the encumbrance items, double click on it, go to the end of it, plus, pointing to the 855,400 and enter. That brings it back down to 0. Okay, and then we're going to go to the next transaction, which is going to say that we had the inventory at this amount. So we're going to record it at actual. So the inventory is going to go up, supplies inventory with a debit, and the other side is going to be cash. So cash is going to be the credit, and that's going to be for the actual amount, which is the 876,400. And so this is the same kind of activity as the prior year. So we're going to say the supplies inventory up top is debited. That's in cell J25 equals, and we're going to go to the debit. And then we have the cash. That's up top in J22 equals. We're going to go to the cash, and that brings the cash down. Now the cash is negative or overdrawn, so don't let that throw you off here. So the cash is overdrawn. Next item, we're saying that the supplies on hand now, the physical count at the end of the time period is 60,000. So if we go back over to our inventory, we're at this 953,500. We need to bring it down to 60,000. So we're going to say, all right, 953,500 minus 60,000. That means we need a transaction for this amount. So we're going to say, all right, inventory needs to go down. I'm going to put inventory on the bottom. So we'll say inventory goes on the bottom. And then on the top, we're going to say that we have the expenditure. And this would be, again, normal type of transaction that we would basically expect to see writing down the inventory in accordance with the physical count on, say, like a periodic type inventory method. So that's going to be 893,500. So the 893,500. And then we'll credit the same amount and record this. So we're going to record the expenditure. That's going to be in J33 equals, and we're going to record the debit, bringing it up. And then we're going to record the credit in inventory supplies in J25. Double click on it, go to the end of it. Plus, we're going to pick up the credit. That'll bring the balance down to 60,000. And that's going to be, of course, our physical count that we had. So now the funny part here, right? Now we got to say, well, now we have this 60,000. It's being balanced out by this non-spendable item down here because we want to apply those out. So these two need to match. This needs to match this. And we're going to say, all right, it doesn't match. We need to fix it. We need to reallocate between the fund balance accounts, between the unassigned and the non-spendable. I need to make this 77,100 to be 60,000. So we're just going to say, all right, there's a 77,100 minus 60,000. That means we need 17,100 adjustment. So in other words, if this is a credit balance, we need to debit it by the 17,100 to make it match the inventory supplies. So we're going to say there's the fund balance. We're going to call it 17,100, the amount. The other side is going to go to the other account, the fund balance unassigned. So we're just going to reassign between the two fund balance accounts to match the fund balance, the net balance that is represented by the asset of inventory, which can't be spendable because it represents supplies that are going to be used. So we're going to have this item in the non-spendable. Here it is, and we are in J28 equals, and we're going to debit this one. That brings us down to 60,000, which is what our goal. That of course matches up here. And now we're in J27 equals, and we're going to pick up the credit and enter. And so we've just assigned that out. So now we've reassigned it. Now we'll do our closing entry, and we're just going to close out the temporary accounts, which only has the one item in it because we're just recording this item, to the equity accounts, typically to the unassigned equity. So now we're going to say last transaction. This needs to be credited. So we're going to put this on the bottom. This equals the expenditure. It's going to be closed out to the fund balance. And it's going to be for the whatever's in there, 893,500, crediting the same amount. So here's the fund balance unassigned. So here it is up top. We're going to be in J27. Double click on it. Go to the end of it, plus, pointing to the 893.5 and enter. And then we're going to close this out in J33. Double click on it. Go to the end of it, plus, and point to the 893,500 and enter. So now we're in our post-closing trial balance. Once again, assets minus liabilities equals the 724,900 equals the what would be equity section, the net assets section, 194,900. And we're saying, hey, of that amount, this is unassigned, this is non-spendable because it represents this asset, which is an inventory supply. So we're going to break that out from the unassigned equity or net asset section. Now we're going to move over to column N, and we're going to do the same thing, but now we're going to use the purchases method. We want to end up in the same place, but we're going to use a different method to get there. So we're going to start off with the same type of process. In order to do this, I'm going to hide some cells. I'm going to hide these cells so we can see our data right next to our next set of accounts. So what I'm going to do is I'm going to put my cursor on L, the drop down, so you can see L, the drop down, and left click and drag over till we get to our data on C, let go, right click on the selected area and hide. So now we have our data side by side. We're now working on the purchases method. We're starting off in the same area. We're going to do the same process, end up in the same place, but go a different way, take a different road. All right, so we're going to start off same kind of thing. We got the encumbrances first, the estimate. So we'll do this a bit more quickly because this is the same exact thing. We got the encumbrances, and then we have the encumbrances outstanding. That's for the estimated amount. Nothing new, nothing different. We're going to post this, encumbrances. We'll post this down here to cell T15 equals. That's going to be the debit. The credit's going to be in the T10 equals. That'll be the credit. So there we have that. That's kind of our holding account. Then we're going to say that we received the supplies. This is where the difference happens. We're going to reverse the encumbrance, no change there, but instead of putting it into the supplies asset, we're going to put it into the expenditure. So we're going to put it into the expenditure now, as opposed to putting it into an asset and then reversing it. So we're just going to say we're going to put this into an expenditure. I'm not going to say all right again. We're going to put it into expenditure. And so we'll have to reverse this exactly. Let's reverse this. Nothing new there. That's the same process. Let's do that first. This will go back down. So encumbrances outstanding is in T10. Double click on it. Go to the end of it plus. Point to the 847.5 and enter. It goes back down to 0. Encumbrances is in T15. Double click on that. Go to the end of it plus. And we'll point to the credit, it goes back down to 0. Now, instead of recording the actual amount to the supplies, we're going to record it all as an expense, even though we haven't consumed it all yet, or an expenditure, similar, same concept. expenditures in essence. Okay, so then the other side of it is going to be going to cash. And this will be for the actual amount. So here's the difference. Last time we recorded the debit to supplies. Now it's going directly to expenditures. So we got expenditures. It's going to be down here in T14 equals the 851.5. Cash, it's going to be in T3 equals the 851.5 credit. Now when we go back over and say that the ending balance is 77,100, that's the physical count. Rather than us having to adjust the inventory like we normally would under a periodic system down, we didn't record it to inventory. What we're going to do is just record the inventory. We're going to, in other words, record the inventory straight off here and then put the difference to the fund balance for the non-spendable fund balance. Now note, as we do this, we've kind of overstated the expenditures on an accrual basis because we've got the whole expenditure down here and we didn't consume all of the supplies. So we're kind of more on a cash basis with regards to the income statement. But once we close out, you'll see that the net equity will be in the same position. So let's take a look at what this will look like. We're going to debit the inventory. So we're going to put the inventory on the books. And you would think that we would be reversing the expenditure, taking it out of the expenditure, because this would be overstated on an accrual basis. But we're not. We're going to take it directly to the fund balance. We're going to put it into the fund balance. We're going to, in essence, keep this more on, in this case, a cash basis because we paid cash for it. But when we roll it out into the fund balance, we'll end up in the same place, reallocated between unassigned and non-spendable. So the other side then is going to be into the non-spendable, and we're going to say this will be for the 77,100. That's going to be the amount that we said is still remaining. So we're going to then say this is a negative of that and post this out. So the inventory now, if we go to the inventory and post this, here's inventory. We're going to be in cell T6 equals, and we'll go down to the inventory. Inventory now is on the books at the same place we were at with the other method. And then we're going to go down to the fund balance, and we want the non-spendable in T9 equals the 77.1. So there we have it. Now these two match up just like we would expect. However, the expenditure is higher than under the prior method. So now we're going to do the closing process. We're going to close out the expenditure and we're going to close it out to the unassigned, and then we'll end up in the same post-closing trial balance. So we're going to say that we need the expenditure to go down. So we're going to credit that, and we're going to put that into the unassigned, and what's in there right now, this 851,500, that's what we need to remove. So we're going to go back over. We've got the fund balance unassigned. Here's the fund balance. We are in T8 equals, and we're going to point to that 851,500. And then we're in the expenditures. Here's the expenditures. Something's in it. Going to double click in it on T14 plus, and then point to the credit and enter. So that brings us back down. So we're back down to zeros down below in the income statement type items. And we have the assets minus the liabilities once again, 168.6. And we've broken that out, represented what would be equivalent to the equity section, net asset type section between the unassigned and the non-spendable. Now we'll move down to year 2, where we're going to have much the same starting point once again. So year 2. You'll note that we took the ending balance, our post-closing trial balance for year 1. That's our beginning balance now for year 2. And so we're going to say that we're going to go from there. And we start off with the encumbrances. So we have the encumbrances. This is going to be the same process as the prior method. Encumbrances outstanding for the estimated amount for year 2, which is going to be this. We're going to post that out. So encumbrances are going to go up. So we'll go to encumbrances. That's in T34. And then encumbrances outstanding in T28. Then the next thing that happens is that we say supplies were received at the actual amount of the 876.4. So we're going to reverse the encumbrance just as we did in the prior period. reverse the estimated amount, and do that exactly. So the estimated amount is going to go back down to 0. Here's the encumbrances outstanding. Something's in it. Double click on it. Go to the end of it. Plus, we're going to point to the debit, making it go back down to 0. Then the encumbrances in T34. Double click on it. Plus, make it go back down to 0. So there we have that process. Then we're going to record the entire amount as an expenditure as opposed to the inventory. This is the difference here. So we're going to say the entire amount is going to be the expenditure, and we're going to record the other side saying we paid cash for it, and that's going to be for the actual amount. So there's the actual amount. There's our debit and credit. So now we have the expenditure. We're going to record the expenditures in cell T33 equals the expenditure. And then the cash, up top, cash is going to be equal to the credit. Once again, it's going to flip it to an overdraw, so don't let that throw you off. And so that's going to be that activity. Now we're going to go back and say that we had the adjustment, the supplies remaining are 60,000. So now we need to adjust what is in the supplies account, which is the 77.1, which is remaining from the prior year. So remember, if it was normal kind of supplies, you would think we would have the prior balance and then we would increase it by purchases and then be decreasing it right now. But we didn't do that. When we purchased, we just wrote it all off as expenditures, and we're left with this supplies thing that or amount that we put on there at the end of last time. So we just need to adjust it then to the 60,000. So it's at 77,100 minus 60,000. We need an adjustment of 17,100. So we're going to say that we have an adjustment that needs to go down. So I'm going to put it on the bottom, and it's going to be for a credit of 17,100. We then are going to need some type of debit, and it's not inventory. It's not going to be inventory. We're going to put it into the equity account for the fund balance non-spendable. So we're going to put it to the equity account. This equals the non-spendable equity. And then when we record this, this is going to be the inventory. Here's inventory up top equals, this is the credit. And that'll bring us to what we would expect, the physical count, 60,000. And then the non-fund balance or the non-spendable fund balance is in T28. That equals the 17,100. So there we have that. So we've adjusted this. Now these, of course, match out. So those match out. Now we're simply going to close out the expenditures, and we're going to close it out to the unassigned portion, and then we'll have the post-closing trial balance assets minus liabilities equaling the net assets, and have them assigned between the two categories. So we're going to say the expenditures then is going to be credited, so I'll put it on the bottom, and then on the top we're going to have the fund balance unassigned. That's going to be for what is in the expenditures currently, 876,400, debit and credit. And obviously there would be more activity. If there was more activity, all we have is the closing out of the expenditures. This is the closing entry. So we have the fund balance unassigned up top in T27 equals the debit. And then we're going to credit the expenditures. So expenditures here, there's something in it. Going to double click on it, go to the end of it and say plus. Point to the credit, bringing it down to 0. So we end up in the same spot here where we have the assets minus the liabilities are 724,900. That equals the equity, 724,900, or the equivalent of equity, the net assets minus liabilities. And that's going to be assigned, and we're going to break out this 60,000 because we're saying, hey, that's applied to inventory that's already been purchased. We'll take a look at the government-wide type of activities. So now we're in column X. We're going to go through the same process, government-wide type of activities. This will be more familiar because we'll be using an actual accrual method. So we will, in essence, compare this to what we would be more familiar with the recording of supplies. So we're going to start off by hiding the activity from the prior so we can see the information right next to our data. So I'm going to put our cursor on column V so it looks like this. Left click and scroll all the way over to anything that's currently open. I'm going to column C, but you want to be right next to column B, whatever's right next to column B, and then right click, and we don't want to delete but hide them. And then we're going to have our data right next to where we're going to enter this information. So this is going to be the same process. We'll do this a little bit faster because this should be the more familiar process if we're familiar with the financial accounting. So the first item is going to have to do with those encumbrances, the estimate. We don't have that here. That's not a normal accrual process, so we don't have that. Then we've got the supplies received at the cost. We got the supplies. Now we're going to record them. We'll record them as an asset, and then we'll count them at the end of the year. We'll use like a periodic type of system. So the supplies are going to be on the books, supplies inventory, and then we're going to say we paid cash for it, for the actual amount. And there's the debit, there's the credit. We're going to post this to supplies. So this is going to be in cell AD6 equals the debit. The other side is going to go to cash. So we're going to be cash in AD3 equals the credit. So there we have that. Next item says that we're at the end of the period going to count the supplies. This is the physical count. So at the end of the period, under a periodic system, we need to adjust this down to the physical count of 77,100. So we would say that we have in supplies 851,500 minus the 77,100 that we have left. Adjustment needed 774,400. So let's do that adjustment. We're going to say that we're going to debit the expenses. So we're not going to put it into an equity or net position account, and we're going to reduce the inventory supplies. This is what we assume that we consumed under an accrual basis. So we had beginning balances plus purchases minus the ending balances is what we assume that we consumed as an expense. And that's going to be, we said, was 7744. Let's post that out. So we have the expense. We're going to put that over here in AD10 equals the debit. And then we have the credit to supplies, inventory and supplies in AD6. Double click on that, go to the end of it, plus, and then pick up that credit and enter. That takes us to the supplies of the 77,100, which is what we would expect. Then the expenses being recorded as what we would think of as what has been consumed on an accrual basis. Then the last thing we're going to do is close out the income statement accounts, in this case just the expenses. We'll close this out to equity, which is going to be just net position. So I'm going to skip a line. We're going to say the expenses is going to be a credit to make it go to 0. And then we're going to debit net position for whatever's in the expenses, which happens to be 774,400. And there we have it. And so net position here is going to be AD8 equals the debit. And then the expenses are going to be here in AD10. Double click on it, go to the end of it, plus pick up that credit and enter. That brings it down to 0. So that would be more of the normal process that we would think of, assets minus liabilities equaling the equity in the net position. Then if we went to year 2, these are our ending balance, closing, post-closing trial balance, and that's going to be our beginning balance for year 2. If we went through this same process for year 2, we would simply say that there's going to be none on the first item, dealing with encumbrances. Then we have the inventory that we bought. We're going to say cash is going to go up. Cash is going to go down. We got inventory that's going to go up. Cash is going to go down for the actual amount, which is going to be that 876.4 debit and credit. Then we're going to say the inventory is going up. So here's the inventory. Here's the inventory. We are in AD26 equals, there's the debit. And then the cash is going to be in AD24. Actually, it's in AD23 equals. The cash is going down. Once again, it's overdrawn. Don't let that throw you off. Next, we're going to say that the supplies at the end, physical count 60,000. So if we go back to our inventory on hand, we've got the 953,500 on hand. So 953,500 minus the 60. We're going to make an adjustment to get it down to 60, 893,500. So this is the same kind of cost of goods sold calculation. We had the beginning inventory, 77,100 plus the 876,400 purchases, amount available minus the physical count at the end, 60,000, we assume under a periodic system we used the 893,500. So then we're going to debit the expense, and we will credit the inventory for the amount of the 893,500, debit and credit. So here's the expense. Here's the expense on our trial balance. We're in AD 30 equals the debit. And then the credit's going to go to inventory supplies. Here's inventory supplies. Something's in it. Going to go double clicking on it. Go to the end of it. Plus. Point to the credit and enter. So that brings it down to the 60, which is the physical count, which is what we would expect. Then if we wanted to close this out, the final process, closing out the income statement accounts, which is just expense to the net position. Let's take a look at that. Expenses needs to be a credit. We're going to debit the equity type account, the net assets type of account, equity being for profit type of account. And that's going to be for whatever's in it, 893,500, debit and credit. So there we have the net position. Net position, we are in AD 28 equals the debit. And then the expenses, here's the expenses, AD 30, something's in it, double click on it, go to the end of it, plus. We've got the 8935 and enter. So now once again we have the assets minus the liabilities, 724,600, and that's going to be in what would be for profit, the equity section, and it's going to be here the net position, or the assets minus the liabilities.